Fixed, variable, split, honeymoon. What's the difference? And how do you know which one is the right one for you? Hi, I'm Dr. Linda Hamilton, author of Pay It in 5. We paid our home loan off in 5 years, and I'm here to break down the 4 main types of home loans so that you can choose the right one for you. The wrong type of home loan could cost you thousands, and not just in interest, but in lost flexibility and hidden restrictions. Whether you're buying your first home, refinancing, or trying to figure out what all these options actually mean. Let's break it down so you can make smart, confident decisions. This video will help you avoid costly mistakes and help you choose the structure that's right for your goals. Here's a mistake I see all the time, and one that we've been guilty of: choosing a home loan with the lowest interest rate without actually understanding the structure or what features it comes with. That cheap interest rate might come with hidden restrictions like no extra repayments, no offset, or really high exit fees if you try to refinance or try to go to a different lender. Let's dive into each of the different types. Number 1, the variable interest rate home loan. With this type of home loan, your interest rate moves in line with the market. In Australia, this is usually influenced by the Reserve Bank of Australia. When the central bank of your country increases interest rates, your lender might adjust the interest rate that you pay as well. So when your cash rate goes up or down, your lender might adjust the interest rate that you pay too. Unfortunately, there's also a downside. When interest rates rise, so too do your repayments. This not only impacts the interest you pay, but it can also be stressful if you're working to a budget, and particularly if you're living day to day or month to month. Variable loans may offer more freedom. For example, you may be able to make extra repayments, you may be able to use redraw, and you may be able to get an offset account. This means you can pay your home loan off faster without being hit with lots of fees. And this is really important if you're motivated to get ahead on your home loan. Here's the trade-off. You get more flexibility, but less certainty. If you want to know more about the offset account, watch this video. If you want to make extra repayments and you're happy to ride the wave up and down as the interest rate changes, then this could be a smart move for you. Variable rates can give you freedom, but you also wear the risk of interest rates rising over time. Number 2, honeymoon loans. Let's talk about a type of variable loan with a twist. The honeymoon loan. A honeymoon loan gives you a temporary lower interest rate home loan, usually in the first 1, 2, or 3 years of your home loan. After that honeymoon period ends, your interest rate reverts back to a higher interest rate home loan, and sometimes higher than the standard interest rate. It's like a really sweet deal up front, and then reality hits. And here's the risk. If you're not ready when the interest rate rises again after that honeymoon period finishes, you could be in for a rude shock with much higher repayments than you were expecting. And that surprise could be a big shock to your budget. Some lenders might let you renegotiate the interest rate when the honeymoon period ends, but do check with your lender in writing before you sign the contract. This can work really well for you if you're planning to make really strong headways at the start of your home loan. If you're laser focused on smashing out your home loan fast, then a honeymoon loan could be the head start that you need. Just don't fall asleep before the real repayments kick in. Number 3, fixed interest rate home loans. Let's move on to the fixed rate home loan. This is the one that can give you peace of mind, but comes with a few trade-offs. With a fixed home loan, your interest rate stays fixed. It stays the same for a set period of time, and this is usually somewhere between 1 and 5 years. This means there's no surprises when interest rates go up, but you also don't benefit when interest rates go down. If you're the kind of person who likes to plan every dollar, particularly in the early years, then a fixed rate could help you to be able to budget more smoothly. But here's where it gets tricky. Most fixed rate home loans don't allow you to make extra repayments. So if you want to smash out your home loan, a fixed option might not be the answer for you. And if you need to refinance or sell during the fixed period, you could end up with exit fees, which could be really expensive. Fixed rate home loans are best if you value certainty and stability over flexibility. Make sure you understand the restrictions, particularly if you want to make changes in the early years. Number 4, split or combination loans. Can't decide between fixed or variable? You don't always have to. Welcome to the split loan. A split loan, like the name suggests, lets you divide your home loan into fixed and variable. So part of it might be fixed and part might be variable. Think of a split loan like wearing two different types of shoes. You've got a sneaker for speed and you've got a hiking boot for stability. It's like having the best of both worlds, but there's a few things to keep in mind. The fixed portion gives you security and repayments that don't change, while the variable portion gives you freedom. You might be able to make extra repayments, access redraw, and when the interest rate drops, you get the benefit. This is a good option if you want certainty, as well as having flexibility to make extra repayments. Just make sure the combo fits your journey. But managing a split loan means two sets of rules, and not all features may apply to both sides. It can also make things a little more complex when you're refinancing or adjusting things later. The structure of your home loan, whether it's fixed, variable, or a mix, can impact how you can repay, your access to redraw, and the fees you end up paying in the long run. It's not just about the interest rate, but how the home loan impacts your life. The right structure can give you control, and the wrong one could cost you thousands. Here's what we did. At the time, for our first home loan, we wanted to pay our home loan off as fast as possible. So 3 things mattered to us: making extra repayments without the fees, access to an offset account, access to redraw. We ended up with a Honeymoon loan because we wanted to pay our home loan off fast, particularly in the early years. We knew the Honeymoon loan wouldn't last, but we used that time to hit the home loan hard, and we went strong with the repayments. This home loan structure suited our strategy. It suited our situation. It allowed us to pay our home loan off faster and to get ahead and stay in control of our home loan. Your goals might be different. You need to choose one that suits you. Maybe you need stability. Maybe you need a tight budget. Maybe your situation means you need predictability. That's why understanding the structure is so important. It's not about the interest rate, it's what works for your situation. There's no one size fits all with a home loan structure. It's important to use one that's right for your situation, your money habits, and your budgeting. Take your time, get the facts, look at your situation, and think about what it is that you need, so you can pick the structure that's right for you. Let me know in the comments what structure you decided and why. Why did that structure suit your situation? And because you've made it to the end, I have an exclusive offer for you. I launched Money Shape Up in 2025, and every month in 2025, I'm giving away a free copy of my book, Paid in 5. If you'd like to win a copy, click the link in the description.